Good afternoon. I am Kathy Neifeld, one of the principals at Agency One. On behalf of my partners and our amazing Agency One team, I am thrilled to welcome everyone to our bi-weekly webinar series. This is the 8th webinar that we have hosted this year, and all of the webinars, with the exception of one, have been recorded and can be found on either the Agency One website or on our YouTube channel. If you are looking for information on asset protection and estate, income, and gift tax planning under President Biden's administration, digital marketing tools, strategies, and resources that you should be using to help drive more business, a premium financing update, underwriting information, a current economic update, or perhaps are interested in an industry perspective from the President and CEO of John Hancock Life Insurance Company, I encourage you to access these webinars. The speakers are renowned industry experts and have included nationally recognized estate planning attorney Alan Brown and advanced markets consultant Randy Zipsey, digital marketing expert Samantha Russell, the Senior Vice President and National Director for Premium Financing at U.S. Bank, Taylor Miller, economist Anirban Basu, and Brooks Tingle, the President and CEO of John Hancock Life Insurance Company. And we even have a webinar featuring our very own superstar underwriting team, led by my partner, Dennis Bartos. For those of you that are new to Agency One, a brief introduction. We are a very high-touch, exclusive BGA. Exclusive, what does that mean? We have a platform called the Agency One 100, and one of our guiding principles is to work with a small, select group of advisors in a very large way. The advisors that are part of this group are like-minded, highly successful, creative, and driven. We focus on life insurance and fixed annuities. If you have other needs like disability or life settlements or standalone long-term care, we have strategic relationships with the best providers in the industry to refer you to. We truly have the premier underwriting department in the industry, led by my partner, Dennis Bartos, and advanced markets and case design departments led by my partner, Gonzalo Garcia. If you want high touch, personalized attention, advocacy, and want to feel like you and your cases are important, then Agency One is or should be your BGA. If you would like to learn more about us, the Agency One 100 platform, and how you can become a part of it, or if you have a case you'd like to discuss, please reach out to us. I have some additional important announcements about what Agency One has planned for the next few weeks, and I will be sharing them with you at the end of the webinar. Now, on to today's webinar. I would like to thank our friends at American General, and specifically Steve Burns, our Regional Vice President covering the Mid-Atlantic Territory, who is here today for suggesting that we speak with Joe Ross, Vice President of Sales Productivity and Business Development with AIG Financial Distributors. Joe is going to talk about the wealth transfer tax tsunami. Everyone is talking about taxes, but there are 3 things the Biden administration would like to do, and if they succeed, it could cause this wealth transfer tax tsunami. Joe is going to discuss what these 3 things are and how you can combat their effects with life insurance. Joe will try to respond to any questions that have been asked at the end of the presentation. So please submit your questions through the question or chat feature at the bottom of the screen, and we will be monitoring them as they are submitted. If they are applicable to a specific slide that Joe is speaking about, we will try and address them at that time. This session is being recorded, so if you miss something, you will have the opportunity to go back and listen again. I'm now going to turn this over to Joe. Thank you.
Thank you, Kathy. Thanks, Gonzalo. And to my wingman, Steve Burns. Steve, thanks for pulling this all together so that we could all be together today. This is really relevant stuff to talk about. I'm finally starting to see some articles being written about some of the things you're going to learn about today. But I built this presentation back in October of last year before we even knew which person was going to be president. but I knew what the Biden administration wanted to do and started building the presentation just in case. And sure enough, I got lucky in terms of building my presentation. It now works. So when people are talking about the tax policies of the Biden administration, I hear a lot about what's going to happen to the taxes of people making under $400,000 a year. What will happen to the people making over $400,000 a year? Will we or won't we have capital gains tax rate increases for investors? All of those things are talking about people that are alive, living, active individuals. But there are a couple of things, as Kathy mentioned, 3 in particular, that have the opportunity to create this wealth transfer tax tsunami. These are things about death tax, and that is not what people are spending a lot of time talking about. In fact, some of the implications to the death tax are purely accidental. They're an unintended consequence, if you will, of some of the tax law changes that the Biden administration wants to make. Now, as we look at each of these 3 things, each of them on their own is not that big of a deal. But if you put all 3 of them together and create what we'll call the perfect storm, then you can have the wealth transfer tax tsunami. Now, none of the things we're talking about, and in fact, I have a caveat screen here. This is largely founded, of course, by my compliance teammates here at AIG, but this presentation is almost entirely founded in speculation based on things that I've heard said by politicians, by the talking heads in the media, the news people, articles that I read. These are things that those people believe could happen in the near future. Nothing in this presentation attempts to imply that any of these things actually will happen. We don't know if they're going to happen. So if we don't know if they're going to happen, why do we even want to talk about this in the first place? Well, interestingly, I delivered this presentation to an audience about 2 weeks ago. And so I delivered the presentation in the morning. The next day, I got an email from one of the participants that said, you know, it's amazingly timely, but that afternoon, after watching your presentation, I was having a client meeting, and my client asked what I thought was going to happen under the Biden administration with regards to the transfer of their wealth from one generation to the next. And he said in his email, thankfully, because I had watched your presentation in the morning, I had all kinds of things that I could talk to them about, and my credibility in the eyes of my clients went way up because I knew the things that they needed to know. So it's not as important to know that it's happening. It is important to know that it could happen. And if it does, you will be at the leading edge of this knowledge pool. So I'm going to start our conversation with 2 quick quotes. One from Ben Franklin back in the 1700s when he said, our new Constitution, now established, has an appearance that promises permanency. But in this world, nothing can be said to be certain. Finish that sentence. Except death and taxes. And we've used this phraseology over and over again to say nothing in life is certain except death and taxes. And that's what leads us to our conversation today. We're talking about death and taxes. And the second quote comes from someone a little bit less well known than Ben Franklin, and a longer time ago, in fact, 500 BC, I'm not sure if somebody found this etched into a piece of stone somewhere or what, but when Heraclitus supposedly said, nothing in life is permanent, nor can it be, because the very nature of existence has changed. So we're talking about death and taxes, and we're talking about change. That's what's going on in our world right now. We want to get our arms around that. So we know the only thing certain in life is change. Let's see how we deal with it. What I want to do first is start by talking about where we are now. And down at the very bottom of my screen in small type, you'll see that I have a website listed here, usdebtclock.org. If you've never gone to that site, it's something I suggest you do after we're done today. It's entertaining. That website has a lot of numbers on it, and these numbers are changing within the second. Multiple times per second, these numbers are changing. I'm going to show you a screen capture I took from that on December 21st as I was building this presentation. Here's the corner I want to show you. So if you go to usdebtclock.org and you focus on the top left corner of your screen, these are the numbers you'll see. And the one that I was noticing was the U.S. national debt, now at about $27.5 trillion. If I had the actual website up, you'd see those numbers increasing at a rate of about $100,000 every 3 seconds. So the U.S. national debt is going up, and it's going up pretty fast. not only is it going up fast, there's another number on the page that you should be aware of, and that's the budget deficit, now at $3.2 trillion. You know, I've been following this usdebtclock.org site for a long time, and you might find it interesting to know. First, let's understand what is a federal budget deficit. The budget deficit is the amount Congress is spending in excess of the amount the IRS is taking in tax revenue. So where does that money come from? How do you spend money you didn't earn? Just like in your house, if you were going to spend money that you don't have, what do? You got to go borrow it. So every nickel of what we spend in excess of what we take in tax revenue ends up becoming part of the national debt. What's interesting is that the budget deficit tells you how fast the debt is going up or going down. And if you look at that federal budget deficit number, what you realize is that the federal budget deficit is currently increasing by about $10,000 every single second. So not only is the national debt going up by $100,000 every 3 seconds now, but the rate at which it's increasing is continuing to accelerate as we continue to overspend the budget deficit. In fact, in 2018, just a scant 3 years ago, the overspend was only, it sounds weird to say only when you say $850 billion, but the overspend in 2018 was only $850 billion, and the budget deficit was getting smaller by about $5,000 a second. Today, take into consideration the Trump tax cuts, the pandemic, and numerous other things that have gone on, and we've gone from an $850 billion deficit that's going down to a $3.2 trillion deficit, 4 times higher, and it's going up by $10,000 a second. But there's another thing on this part of the usdebtclock.org page that I always found interesting. If you go back over the last 60 years, back to the year 1960, and take a look at the ratio of the federal debt to our gross domestic product. Back in 1960, our debt was about half of GDP. By 1980, we had reduced the debt to about 1/3 of our GDP. By the year 2000, we had taken it back up to approximately half of GDP. But in the last 20 years, look what's happened. We've gone to an astronomically high number. That's 4 times higher than what it was in 1980, 2.5 times higher than what it was in the year 2000. And now our debt is 28% greater than our GDP. Now, that's a noteworthy number because over the last 60 years, and I could go back even further, but usdebtclock.org does not, we have an historical anomaly here in the amount of debt we have relative to our GDP. And I've heard Janet Yellen recently say, you know what, I'm okay with our high level of debt because interest rates are so low. You know what the problem is with that? If the national debt keeps going up and if interest rates turn around and start to go up, we could be strangling on the debt interest payments, not just the debt itself. I always say to people, is it better to try to pay down debt when interest rates are high or interest rates are low? And the answer is when interest rates are low, because you don't have much interest, you're paying down a lot of principal. If interest rates are high and you're trying to pay down debt, you first got to climb over that big interest payment before you start knocking down any principal. And we are doing the exact opposite right now. While interest rates are low and we should be paying down the debt, we are ramping it up, and that could come to haunt us later. One of the other things interesting about this usdebtclock.org site is there's a button on the screen that lets me forecast it out 4 years. So this was in 2020, and I could forecast it out to the year 2024. Remember, if I go back to this previous screen, the national debt, as you can see, was $27 trillion right now, back in December, and $3.2 trillion of budget deficit. What's projected to be in 2024? Well, that $27 trillion of national debt is projected to be nearly $50 trillion of national debt. That's the equivalent of a 17% compound annual growth rate on the national debt. Considering the trends that are in place right now, this is what would happen. If you look at the budget deficit, we are on track to have an overspend in 2024 of $5.6 trillion. Now, let me give you some perspective on that. In the year 2000, the entire national debt was less than $5.6 trillion. We are going to overspend. We're on track to overspend in 2024 in 1 year the entire amount of what the national debt was in the year 2000. Now, That may or may not turn out to be a problem, but it certainly has me a bit concerned. Also in 2024, take a look at that debt to GDP ratio. It skyrockets from the current 128% to 170%. Now, again, compare that to where we've been over the last 60 years, and that number makes me a little nervous. Now, why do I bring this up? Well, it's because as the Biden administration is coming in, they're talking about needing to increase tax revenue. Anybody see any reason why that would be important? Duh, right? And this is why when you ask your clients, which way do you think tax rates are going to go in the future? Are they going to go up, they're going to go down, or are they going to stay the same? Everybody I talk to is expecting tax rates to increase. In fact, as a president is concerned, there could be no better time to introduce legislation to increase taxes than at a time when everybody expects it to happen. In fact, many Americans believe we need it because of the size of the burgeoning national debt. So I think it's likely that taxes will increase in a number of different ways, not only on day-to-day taxes of the people who are alive, but also what we're going to talk about today. That's the taxes on the people who are dying. So what we're going to do is connect the dots here. Because of these three possibilities, if you look at them separately, they don't seem really that impactful. But if you look at them in combination, it's a big deal. We don't know if any of them is going to happen, but if they did, what would be the result? What creates this tax tsunami? So what are the three things? The first one is they want to reduce the estate tax exclusion limits. And we all know the estate tax exclusion limits are really high right now at, $11.5 million per person, $23 million per couple. It wasn't that long ago when the estate tax exclusion limits were $1 million per person or $2 million per person. That wasn't that long ago. So it doesn't seem like too big of a stretch of the imagination to just take the estate tax exclusion limits back to where they were. And if you do that, what are you doing? You're triggering more estate tax on who? Wealthy people, people that have over $10 million. It's exactly consistent with the Biden administration's policy. The second one is the elimination of the step up in basis of death. Now, this one really bothers me. And we're going to talk about why this one really bothers me as we unfold that part of our conversation. And the third one is that the Biden administration wants to increase the capital gains tax rates. And his most important concern with the capital gains tax rates is on living investors that are buying and selling capital gains assets. And basically what they're saying, I didn't realize this at first. I watched a presentation about 2 weeks ago where I first figured this one out. I was thinking when the Biden administration was saying they want capital gains tax rates to basically go away if you have over $1 million of gains. I thought that they were saying that if you have over $1 million of capital gains, that excess capital gains would be taxed at ordinary rates rather than a capital gains tax rate. I come to discover from one of my colleagues that it's not about how much capital gains you have, it's about how much total income you have. If your total income from all sources exceeds $1 million, the Biden administration is suggesting that you will no longer benefit from capital gains tax rates. We'll talk about all three of these, none of which is that big of a deal all on its own. But boy, when you put these together, we've got something to think about. So let's start by talking about the reduced estate tax exclusion limits. So let me ask you a question. If you had to guess, with our current limits of $11.5 million per person, $23 million per couple, take a shot. What percent of the people that died in 2020 had a taxable estate and paid estate taxes? What percent of the people is that? Is it 5%, 10%, some other number? What do you think? Take a guess. The answer is less than 1/10 of 1% of the people that died in 2020 had a taxable estate. So with the limits where they are today, where we have $11.5 million per person and $23 million per couple, very few people are paying estate taxes. However, think about who those people are. That's right, they're the wealthiest people. So I thought to myself, I know what's going on here. Very few people are paying estate taxes, but they're paying a lot of taxes. So I had a second question, see if you can answer this one. What percent of total IRS tax revenue do you think came from estate taxes, from people that died? Okay, so I'm thinking a small percentage of the people paid estate tax, but they're really wealthy. They probably paid a lot of tax. I'm thinking that's a pretty big number. I was wrong. The answer is Only 0.6% of total tax revenue in 2019 came from estate taxes. Only 0.6. Now, 0.6% is disproportionately large compared to the 0.1% of the people that had a taxable estate. So that helps us to see that they were all wealthy. But the point here is only 0.6% of total tax revenue came from estate taxes. In fact, that is such a small piece of the total pie that the US government spends the entire estate tax revenue in less than a week. The other 99.4% of tax revenue came from somewhere else. It came from ordinary income taxes to you and I. It came from corporate income taxes and places like that. So you almost start to wonder, why do we even have an estate tax at all when we have limits so high? And remember, there was debate about repealing estate taxes altogether. We're almost there because the estate tax revenue only funds the government for a week. So you think to yourself, why did estate tax exclusion limits increase? Well, think back. IRAs first became available in 1975, followed by 401ks in 1978. Prior to that, what was going on? Everybody had a pension. If you retired with a pension, who owned all the money that supported the pension payments? That's right. All the money was in the hands of the corporation that you retired from. And so they would pay you an income for the rest of your life. And when you died, how much asset did you own? Well, next to nothing. You had Social Security income in which you had no assets. You had pension income in which you had no assets. So people died in those earlier years had very, very small estates because they didn't need to own the assets. But what happened in the 1970s was a bit remarkable and a little bit unexpected. When these 401ks became available, corporate America realized that people could start saving on their own. So what happened? The corporations started discontinuing their pension plans. Underneath that decision, what happened? All of the wealth that used to sit in corporate America supporting pension payouts has now been moving into the personal investment accounts of the investors, the employees who are funding their 401k plans. So what we watched is a shift of wealth from the corporations to the individual's back pockets. And if the IRS or if Congress had not increased the estate tax exclusion limits, while all of this massive wealth switched hands from the corporation to the individual employees and investors, well, estate taxes would have become a huge problem by today. So we watched the wealth shift from the corporate coffers to the employees, and that created an environment where estate tax exclusion limits had to increase in order to control the magnitude of estate taxes on the wealth from one generation to the next. So that's the estate tax exclusion limits. Reduce those limits, what's going to happen? A lot more people are going to pay estate taxes. And not only are a lot more people going to pay estate taxes, but those wealthy people who were already going to pay estate taxes are going to pay estate taxes on even more of their wealth. Also, keep in mind that when the estate tax exclusion limits come down, something we haven't talked about for a long time comes back to the surface, and that's the double tax on these retirement plan assets, being taxed once by estate taxes to the decedent's estate, and then being taxed again with income taxes to the beneficiary. We haven't talked about double taxation on qualified plan assets for a long time because the estate tax exclusion limits are so high. But if you bring those estate tax exclusion limits way back down again, we'll be right back where we were before, talking about double taxation on qualified plan assets. Now let's talk about the real burr under my craw, that elimination of step up in basis at death. Why does that bother me so much? Well, I often say to people, I love estate tax. What's not to like about estate tax? You know what people will say to me? They'll say, Joe, estate tax is just patently unfair. Why should the government be able to tax me just because I own stuff? Well, if that's the conclusion you drew, unfortunately, you're making an uneducated statement, because here's what happens. I say, what's not to like about estate tax? If you didn't have estate tax, what would you have instead? Let me tell you a little story. Way back when, before estate tax existed, investors had assets that had capital gains in them. And when they died, the tax had to be paid on those gains in those assets. Now, this was not an easy thing to do. Why? Because when you die with capital gains and you have to pay capital gains tax, the only way you can pay that tax accurately is if you know the cost basis in the asset. And the problem is the decedent's executor couldn't find any documentation of the basis in these assets. They'd be going like crazy trying to find receipts and any kind of documentation. And we got evidence of this in 2010, the 1 year in recent memory when estate tax was repealed. They repealed the estate tax. So instead of paying estate tax, what did people have to pay? Capital gains tax. It drove the world crazy because you had to find the receipts. So I say, what's not to like about estate tax? Have you ever wondered why we have a step up in basis at death? It's because Congress realized what a mess capital gains tax is simply because of calculating cost basis. So basically the conversation went something like this. Let's make life a lot easier. Instead of paying capital gains tax and trying to figure out cost basis, let's replace it with estate tax. Estate tax will be basically a substitute for capital gains tax, but it's going to be way, way easier because you don't have to find your basis. Just add up the value of your assets and pay tax on that. So estate tax is a substitute. It's a replacement for capital gains tax. And that's why we have a step up in basis at death. The step up in basis at death gives the government a way to continue to have capital gains tax for active investors, but not have capital gains tax at death, so that you can have estate tax instead, and the world will be easier. You see, estate tax at death and capital gains tax at death are both death taxes. Logically, we should have one or the other, but not both. In fact, if you go back to the history, the very beginning of estate tax, I believe it was 1906, you go back to the very beginning of estate tax, there has never been a time that I'm aware of, and I've checked with a couple of my colleagues on this as well. We are not aware of any time in the history of the US tax code where we have had both estate tax and capital gain tax at death. This could be the first time in history where we've had both. So my problem is capital gains tax is simply much more difficult to calculate, and estate tax is much easier to calculate. So what I like to say is this: if I was given a choice between paying estate tax at death or capital gains tax at death, I'll take the estate tax all day long. But here's the problem. A lot of people haven't thought about this. If they reduce the estate tax exclusion limits so that more people owe estate taxes, and they eliminate the step up in basis at death so that people also pay capital gains tax at death, we will, for the first time in the history of the US tax code, have an environment where not only do the retirement plan qualified assets get double taxed at death because they get estate tax and income tax, we will also have your non-qualified assets getting double taxed at death by consequence of estate tax and capital gains tax. First time in history where we will have had double tax on both. And now you're starting to see the beginning of the wealth transfer tax tsunami. So what does step up in basis do? When you impose an estate tax, you use step up in basis at death to make capital gains tax go away. And you do that with step up in basis. So that knocks off our first two topics. Let's look at the third part of the trifecta: increasing capital gains tax rates. So the question you might ask yourself is, why do we even have capital gains tax rates? Many of us just grow up knowing that they're there. We have no idea why. We just assume they're there because they've always been there, right? So we always had capital gains tax rate. The question is why? Why do we have capital gains tax rates? Why do you pay lower taxes on your capital gains than you pay on your ordinary income? Why is that? It's because when you have a lower capital gains tax rate, it creates an incentive for investors to invest in US public companies, which then in turn spurs the American economy. So capital gains tax rates are there to support the American economy so that investors have an incentive to invest. But there's a problem here. Only a certain part of the population gets to even worry about capital gains tax rates, and that's the people who have the money. Wealthy people are far more likely to be investors than poor people. Wealthy people are far more likely to encounter significant capital gains than poor people. So when the government gives a lower capital gains tax rate, Ordinary investors who don't have the opportunity to invest in these capital gains assets feel like this is a tax break for the wealthy. And again, this is one of the things the Biden administration has made clear they don't want to do, create tax breaks for the wealthy. We need to get the taxes from the wealthy so that we don't have to raise taxes on everyday people, everyday America. So you can see all three of these things are consistent, but what are they going to raise the tax rates to? Some circles say that the Biden administration wants to raise that rate to 28%. Some are saying that if we get over $1 million of total income, it's going to raise your capital gains tax rate to equal ordinary income tax rates. Now, from an investor's standpoint, this basically eliminates that tax preference for wealthy. And there is your trifecta. What about the perfect storm? We talk about each one of these individually. What if estate tax exclusion limits come down? What if a step up in basis gets eliminated? What if capital gains tax rates increase? Those are all fine and good. None of them on their own is that big of a deal. But watch what happens when we put all three of them together. The best way I can describe this is with a very simple case study. Now, I know that estate tax calculations are complicated. What I'm going to share with you here is back of the cocktail napkin math, the kind of math that we do on an everyday basis on a legal pad or a cocktail napkin. So it's just kind of a broad overview. We're not filling out any tax forms here. We're just talking about the way we normally talk about this. So here are my assumptions. Regardless of whatever the estate tax exclusion limits are at the time, regardless of whether the decedent is an individual or a married couple, let's just assume that we have an estate that's worth $10 million more than the estate tax exclusion limit. So there's $10 million from this decedent's estate that's going to be exposed to estate taxes. Let's use today's estate tax rate, which is basically 40%. This math is real easy. We can do this one in our sleep. We've got $10 million exposed to estate tax and a 40% tax rate. That easily equates to $4 million of estate tax. So let's just say in today's world, we've got somebody that can shelter $23 million from estate tax. They're actually worth $33 million. That's where they got the $10 million of exposure. So they paid $4 million of estate tax on a $33 million estate. That's not that egregious. It's a real number. Sure, $4 million is a real number. And maybe we want to buy a $4 million life insurance policy and put it in an irrevocable life insurance trust to restore that value. But that's a story for another day. The simplicity here is that under today's tax environment, if you died with $10 million exposed to estate tax, you'd owe about $4 million of estate tax. Now let's apply the perfect storm. Let's see what happens if we, A, reduce the estate tax exclusion limits, B, get rid of step up in basis at death, and C, increase the capital gains tax rate. So what are our new assumptions? We've got to add a couple because we have now a capital gains tax play in here. So our first assumption in this next scenario is that we're going to reduce the estate tax exclusion limits by $10 million. So in our previous example, there was $10 million exposed to estate tax. Now there's another $10 million exposed to estate tax. So in this example, we're going to have a total of $20 million exposed to estate taxes. Secondly, we're going to assume step up in basis is eliminated. Well, if we're going to do that, we have to figure out on this $20 million sleeve of assets, how much of that is exposed to capital gains. So we're going to assume that the $20 million of exposed assets has a cost basis of $5 million, which gives it a built-in capital gain of about $15 million. And what are we going to tax that at? Well, let's assume that the capital gains tax rates increase to 28%. Now you have the formula, you have the rest of the assumptions. Let's apply these to the same case study where we just paid $4 million in total wealth transfer tax. Now we have 20 million exposed instead of 10 million exposed. We'll apply the same 40% tax rate and we've doubled the estate tax from 4 million to 8 million. That in and of itself starts to turn into a real number. Remember, this is the exact same $33 million estate, now paying $8 million of estate taxes. And this $20 million sleeve of assets has $5 million of cost basis. So it has $15 million of built-in capital gains, which we assume we're going to tax at 28%. Now, this could be taxed at 40%. We don't know yet. I'm just taking a shot in the dark here. At a 40% tax rate, that would cause this to be a $6 million capital gains tax. At a 28% tax rate, it's $4.2 million. If you add the $8 million to the $4.2 million, Now, instead of the $4 million of tax that we paid in the previous example, we've tripled that number to $12.2 million of tax. In fact, if you take this $12 million of total tax that's attributable to this $20 million sleeve of assets and you divide one into the other, the answer you get is that the effective tax rate on this $20 million of exposed assets is now at 61%. Now that becomes a really significant number. And this is what happens in the event of the perfect storm. Again, we talk about the double taxation. In this scenario, our client paid both estate tax and capital gains tax on their non-qualified assets. And we could also see that double tax appear on their retirement assets, which means virtually all of the assets your clients own at death could be exposed to double taxation for the first time in the history of the U.S. tax code. And we didn't really say anything about what happens to ordinary income tax rates, even though most people believe taxes are going to go up in the future. We're talking about ordinary income taxes for people earning over $400,000, capital gains taxes on people earning over $1 million, and all of these death taxes. It sounds like I'm just saying bad, bad, bad news. This is all bad. But there is a huge silver lining on this cloud. What is that silver lining on the cloud? Silver lining is this. Anytime income tax rates or wealth transfer tax rates increase, people will look for ways to reduce their taxes. If there's an increase in income taxes, what's going to happen? The tax advantages of accumulating money inside of a life insurance become even more attractive than they are today. The tax-deferred growth, the tax-free access, and the tax-free death benefits to the beneficiary become more attractive if tax rates increase. So I see a huge opportunity here. If tax rates go up, we're going to be selling more of these LIRP-type life insurance solutions, life insurance retirement plans.
Hey, Joe.
What else? Kathy, I see you popped up on the screen. Do you have a question?
I did pop up because we had a question before you move on, which I think fits right into where you are right now. And the question was, if the capital gain, does the capital gains tax reduce the size of the estate for tax purposes?
That's a great question. And my crystal ball is a little fuzzy on that one. If I'm understanding the question right, you're saying to yourself, yeah, but Joe, if the capital gains tax was, let me go back to my example here. If my capital gains tax is $4.2 million, does that mean that I can reduce my estate by $4.2 million, which could reduce my estate tax? Will there be some sort of offset there? That's a really good question that we don't know the answer to yet. We'll have to wait and see on that one. Again, nothing has been proposed yet. There's nothing for us to look at to be able to see if that's going to happen. It is possible that the bite won't be quite $12.2 million. It could be more in the neighborhood of $9 or $10 million, but still more than double the wealth transfer tax costs that we have today. But again, if they give us those corresponding counter credits of capital gains tax against the estate tax, only time will tell. We'll see where that goes. Get back where we were. If individual income tax rates increase, I expect to see a surge in things like indexed universal life, where people are trying to stuff a lot of money in there to grow that as a retirement supplement so that during their retirement years, they won't necessarily pay tax at a higher tax rate because they'll have tax-free income coming out of their life insurance policy. What about step-up in basis? Now, I watched a presentation where they had one of the economists from PIMCO commenting on some of this stuff, and she said in her remarks that there was a high likelihood that step-up in basis at death could be repealed. What happens if it is? Well, life insurance can do something that most of us don't think about, and I'm going to explain it by way of an example. If you had let's just say you bought a guaranteed death benefit life insurance policy for a $1 million death benefit. Now, over your lifetime, let's say you bought it when you were 50 years old. Now, if you go out and calculate the premiums for stuff like this, you'll find that this number kind of makes sense. If you bought this policy when you're 50 years old and paid premiums until you died, you're probably going to pay somewhere in the neighborhood of about $300,000 in premiums. And then when you die, your beneficiaries are going to get $1 million in death benefits. Now, that seems like kind of a good deal, and that's the way life insurance works, right? Here's the key here. We have cost basis in life insurance too. If you paid $300,000 in premiums, you have a $300,000 cost basis. But if you die, your beneficiaries get $1 million income tax free. In other words, you paid no tax on the $700,000 increase in value. Now, does something about that sound similar to a step up in basis of death? It sure does, because if you had a step up in basis of death, your basis would have been increased from $300,000 to $1 million, and then the beneficiaries would pay no tax when they sold the asset. Well, that's what happened here. Your basis was $300,000, beneficiaries got $1 million, and there's no tax. It's like getting a step up in basis. I believe that if the step up in basis of death gets repealed, we will find opportunities to move significant amounts of assets that could be subject to capital gains tax at death, find those assets shifting into life insurance policies where the death benefit will be income tax free, essentially giving them a guaranteed future value and the equivalent of a step up in basis of death. And then the third part of this trifecta, what if the estate tax exclusion limits do come down? We go back to what we were doing a lot of just a few years ago, and that's putting life insurance inside of irrevocable life insurance trusts to help people be able to restore the value of their estate and preserve the value of their legacy. It goes from one generation to the next. So we can all ask ourselves, Joe, this is a lot of stuff you're talking about, estate tax exclusion limits coming down and capital gains tax being repealed and capital gains tax rates going up. Is it possible that will happen? Would tell you that a lot of stars would need to align for all three things to happen. Now, a couple of stars are aligned right now. We've got the Democrats in control of the White House and the House and the Senate for the next 2 years. There's a lot that could happen in that 2-year period of time, and there's things they might be able to get through that we would not expect. But we already know there's going to be pushback, especially on any tax rate increases. We're already hearing rumors about that. So politics as usual. These are pretty dramatic changes, especially when you talk about increasing the capital gains tax rate. How are people going to respond to that? Is there going to be a reaction by investors saying, you know what, I don't have as much incentive to invest in corporate America because I'm not getting the tax break of capital gains tax rates? I don't know how people are going to respond to that, but these are fairly dramatic changes. So the question is, can the economy handle it if people react to these changes? And then lastly, I expect pushback. The Republicans are against the Democrats on many of these issues. There will be a lot of pushback, and I'm not sure whether any or all of these can happen, but what if they do? I had a friend of mine who once said to me, Joe, there's two things you don't want to watch being made. And he happened to make this comment to me while we were at dinner one night, and I was eating this big, beautiful sausage. And he says to me, there's two things you don't want to watch being made: sausage and tax law. If you watch sausage being made, you'd never eat sausage again. So I'll tell you, I've never watched sausage being made. I don't want to watch sausage being made because I love sausage way too much. I also love tax law. I have a lot of fun manipulating and working in and around the tax law to find opportunities and solutions that will help our clients, but I don't want to watch it being made. So we don't know what's going to happen. Any of these tax law changes, whether it's one of them, two of them, or all three of them, could create tremendous life insurance opportunities. So what are we supposed to do? Well, I finish with a couple of quotes. The first one from Sigmund Freud back in 1911 when he said, "It's in human nature that people make decisions to avoid pain and create pleasure. If the government institutes tax law changes that create pain, our job is to relieve that pain and introduce pleasure using life insurance products." And that's something we're very good at doing. So as people want to avoid that pain, we'll help them do that and help them create pleasure. The second quote that I'll finish with is, "For every action, there's an equal and opposite reaction." That's a physics statement from Isaac Newton. We've all heard that probably back in high school. For every action, there's an equal and opposite reaction. Well, why do I put that quote in here? Because the government is planning to take action. We and our clients have the ability to make an equal and opposite reaction to offset the effects of the actions that they take. And that's why we're here, and that's how we help our clients stay ahead of the curve. I know that was a lot to cover. I do see a number on the questions box. It looks like there was a couple questions that came in. Kathy, what are you seeing?
First off, sorry about that. I had to get myself off of mute. Joe, I don't see any questions that came in through the Q&A.
Looks like there's some chat in the chat box.
In the chat, and I don't see any questions there either, but for the one that we asked about the cap gains tax. Here's one, which just popped up. If the capital gains rise on $1 million of total income, let's say someone makes $400,000 of income but sells something for $5 million in cap gains. Is that cap gains total income or not because they only made $400,000?
Yeah, the way I understood that from my colleague who made this presentation last week that I was watching, it's all sources of income. If all sources of income exceed $1 million, then that capital gains would lose its capital gains favorable tax treatment. Now, again, that's a rough category. It's a broad category. We're not exactly sure how that tax legislation would be worded or what it's going to mean, because I immediately started asking myself questions like, okay, does that mean that if I had $400,000 of income and $5 million in capital gains, the first question I ask myself is, okay, I'll pay ordinary income tax on my $400,000 of earned income. That makes sense. Everybody gets that. Would I get capital gains tax treatment, the favorable capital gains tax rates on my first $600,000 of capital gains that takes me up to the $1 million threshold, and then lose my capital gains tax rate on the amount in excess of that? That's kind of the understanding I had from my colleague who was explaining this last week. Again, we don't know until somebody submits something in writing, but that's my expectation in how that's going to work.
Thank you. Another question that came in was, do you see the use of ILITs changing with potential change in tax laws? And if so, what alternatives will be available?
Well, one of the things, everybody on the line, if you don't know it already, you will quickly find out Agency One has specific expertise in premium financing. And right now in our low interest rate environment, we can do a lot with irrevocable life insurance trust financing with premium financing strategies. I don't expect the way we do this to change much other than that. I anticipate that we'll start rebuilding irrevocable life insurance trusts. And I regret to have to say that. And the reason I regret to have to say that is because I know there are probably people on this call right now who had clients who had put a life insurance policy into an irrevocable life insurance trust maybe 10 or 15 years ago. And when the estate tax exclusion limits went up so high, they decided they didn't need it anymore. And they may have disintegrated their irrevocable life insurance trust and said, I don't need it anymore. And now they may need it back again. That would be unfortunate. And I'm sure there will be people like that. But I do expect that if the estate tax exclusion limits come down, we will start doing a lot of irrevocable life insurance trusts. The question becomes, which types of policies will we use and how will we fund them? Will we use split dollar again? Will we use premium financing again? Will we use family foundations, limited partnerships? All of those things start coming back into the foray again. So lots of opportunities.
Thank you. Another question was, I have business owner clients with installment sales, and I'm wondering if they should opt out and just pay all cap gains this year, even though they'll have no income in future years. The cap gains could push them up by themselves. That was the comment.
Yeah, that's a tricky one. You know, I certainly wouldn't pull the trigger yet. I think we have time. I don't anticipate any of these tax law changes taking place in the year 2021. I believe with the pandemic and the social unrest and a lot of the other things that the current administration is dealing with, I don't anticipate any major tax legislation that would be effective in 2021. Even if they propose it this year, it's going to take them the rest of the year to finish it. I would likely expect it to go into effect in 2022. So for those clients, I would say we're going to keep an eye on this and let's reconvene in October or November and see what we know then. It might be a smart move for someone that's in the middle of an installment sale like that to get it done and get out of it so that they don't carry their capital gains tax into next year. But again, it depends on whether that limit's $1 million of capital gains, whether it's all income up to $1 million. There's so many variables in there yet, we don't know. But it's a great point to bring up and a good one to keep your eye on.
Okay, thanks, Joe. Another question that came in, would the issue of cap gains be treated as IRD, crediting the income tax with the estate tax paid, like it is with IRAs that are part of the estate assets, merely speculation on our part.
You're right on that last part. I'm going to speculate here. And again, this came up with one of my colleagues who's a far more sophisticated tax expert than I am in this presentation I watched last week. There's some debate starting to stew about whether the capital gains tax, if step up in basis is eliminated, will the capital gains tax apply to the decedent's estate? In which case, then you run into that deal where, okay, do I then get to deduct my capital gains taxes from my estate values before I calculate my estate tax? That all comes into play if it works that way. But the other thing that could happen is that if they eliminate capital gains step up in basis at death, it might simply result in a carryover basis to the beneficiaries. So you might have a $10 million asset with a $1 million cost basis that had $9 million worth of capital gains. Your estate might not pay any capital gains tax on that. That asset may pass to your beneficiaries with a $10 million value and a $1 million cost basis. And by the time they sell it, it might have a $15 million value with a $1 million cost basis. And at that point in time, the capital gains tax will be paid. So the net result of that is we don't know yet how they would eliminate capital gains step up in basis at death. Would they do it in a way that causes the capital gains to be paid by the decedent's estate? Or would they do it in a way that causes the capital gains tax to be paid by the beneficiaries? We don't know that yet, and that's why it's speculation. It'll be interesting to see what they do.
And that specifically dealt with the follow-up question, which was asked by someone, which was regarding the step up in basis and when the recognition would occur, at the death or when the asset was sold by the second generation.
That's right, exactly. No, I'm eager to find out. I have just this gut instinct that when the government came out with the Secure Act and they eliminated the ability to stretch IRAs over the beneficiary's entire life expectancy, what they basically did is accelerated the tax on all of those inherited IRAs, right? What that's telling us is that the government has a specific intention to try to accelerate taxes. If I was to maintain that mindset, it would lead me to think that the government is going to want the decedent's estate to pay the estate tax. If they allow carryover basis to go through to the beneficiary, that beneficiary could wait 25 or 30 years before they sell that asset, simply deferring the income that the government wants. So I don't know which way they're going to go on this, but if we use the Secure Act as any semblance of precedence and what they did with the lifetime stretching of IRA beneficiary distributions, it seems to create a precedent that suggests that the capital gains tax may be structured in a way so that it's due immediately upon death. But again, we don't know. Good question, though.
Some more questions have come in, Joe. Another one is the $400,000 limit per person or per household. If you file a joint return, what is the limit?
That's a good question. All I've heard tossed about is if you earn over $400,000, then the Biden administration wants to tax you at a higher level. Anybody earning under $400,000, no. But I've never heard anybody say, what we really mean is $400,000 per individual, $500,000 per couple, or $300,000 per individual, $400,000 per couple. That's a good question. I have not heard anybody address that. If anybody on today's call has heard anything definitive about that, chime in the chat window and let us know if you've heard anything on that. I have not.
And then we've got another question, which was about non-grantor trusts. And there's chatter that non-grantor trusts might have assets valued and taxed on paper gains every 21 years. Have you heard anything regarding that?
That is not on my radar screen. Kathy, have you or Gonzalo heard anything about that yet?
I have not heard anything about that, but I will go out and ask some people.
If it looks like Gary submitted that question, Gary, if you have any documentation on that, if you would share that back with Kathy, and then Kathy could share it back with me, I'd love to see it, but it hasn't hit my radar screen yet. So good Sherlock Holmes work to have found that in the first place.
Joe, your colleague Steve Burns is chiming in that the $400,000 limit is per family.
Thank you, Steve. So that
so
would suggest to me that there might be a different limit for a single filer, but I don't know. Steve, if you find any information on that, go ahead and chime in on it. Thanks for jumping into the chat box. Yeah, he must have looked that up on Google. That's right, Gonzalo. I don't think he knew that off the top of his head.
I think that our colleague Steve Burns absolutely knew that off the top of his head because he knows that kind of information. So
that's right.
Good luck. Good one, Steve. I do not see any additional questions. If you've got any, and we're coming up on the top of the hour. So if you've got any more questions, please let us know, type them in. Otherwise, I am going to pivot to some closing remarks. But before I go there, Joe, this was fabulous. And I know this is what you're keeping you're staying laser focused on what's happening and what we can expect. So let me ask you this before I pivot to my closing remarks. We're all obviously interested in doing planning, talking to the clients, and solving these issues with life insurance. So do you sell to worst case scenario? Do you sell to middle of the road, or do you sell to cover what the situation is right now? I mean, how do you market it comfortably? What would your suggestion be?
Wow. I first got into the financial services business in 1978. And so this is my 43rd year in financial services. And I have witnessed an incredible amount of change. And every time we thought things would stay the same, things changed and we continued to adapt. And I guess my advice would be this. I had a colleague of mine once say to me, if you wait until the time when the tax code is completely settled and it's going to stay that way and stay that way for good, you will never get anything done and your clients will lose. So what they say is that the best thing you can do is plan around what you know for certain with an eye towards what you think might happen and plan into that. Just try to set up your plans in a way that they are flexible and adaptable in the event things change. So I think we have to go with what we know now, but I think we are on the verge of a significant change. So I think it would be really hard to do significant concrete tax planning in 2021, knowing that 2022 could be a very different landscape. If I was going to be preparing for increased estate taxes, I would be looking to consider buying a policy now that I might not put in an irrevocable life insurance trust, but be prepared to create the ILET next year, shovel that policy into the ILET, and then maybe have to buy additional life insurance at that time. That's what I mean by being flexible and adaptable as the future situations may change. So give that some thought. The other thing that I think might be interesting is when we get into this ILET space, we are for the first time seeing a reduction in estate tax exclusion limits. We've never had a reduction in estate tax exclusion limits before. They've always gone up, 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 up. This is the first time they've come down. And that could lead to more estate tax instead of less. But if they went back up again, we'd have less estate tax. So one of the things I start thinking about is if I had what I believe to be a $2 million estate tax liability, but I wasn't sure if it was going to get smaller in the future, I might consider buying two $500,000 policies instead of one $1 million policy, giving me the flexibility to simply lapse one of those two policies if it turns out I don't need it anymore. That's the kind of flexible planning I think we all have to keep in mind.
Joe, that is great advice. I do not see any other questions that have come in. So let's now talk about what's next. During the week of April 26th, Agency One is going to be hosting a very special two-part webinar series on products and product updates. Specifically, on Tuesday, April 27th at 3 o'clock, we are going to discuss a few carriers that have recently announced changes to their product portfolios and how these changes specifically impact conversion opportunities and what you should be discussing with your clients now. On Thursday, April 29th at 3 o'clock, we are going to be talking about the whole life marketplace, some recent changes that have taken place, and also introduce a new carrier to Agency One and some new opportunities. Lisa will be sending out invitations to this two-part product series next week, so please mark your calendars now for April 27th and April 29th at 3 o'clock, and be on the lookout for the invitation. Joe, Steve, and the rest of our friends at American General, I want to thank you for this informative and lively presentation. These are my closing announcements for today. If anybody has any questions or would like additional information, please reach out to me, Gonzalo, or Dennis. Thank you for joining us. And that concludes this webinar. Thank you.